And today's webinar is closed to the media. We are available for comments and questions after. So if you're part of the media, if you could jump off the call at this time, that would be great. And if we could ask that you keep yourself on mute at this time. If you do have questions throughout the presentations, you could type these in the chat box, and we will get to them in between the two different sessions. There's new information every day about the SBA loans and the PPP. To help us understand all that is loan forgiveness and beyond, I would like to welcome from Wipfli, Lonnie Charles, Kevin Cherney, and Terry Hoover. Terry, would you like to start us off?
Well, thank you, Mickey, and thank you to the Green Bay Chamber, and most importantly, thank you to all of you who have tuned in to join us today. For those of you who are not familiar with Wipfli, we are a Wisconsin homegrown and Wisconsin-based CPA firm that has grown to the 20th largest accounting and consulting firm in the country. We currently serve the greater Green Bay market and the Fox Cities with almost 200 associates. And on behalf of them and our 2,300 associates throughout the world and the United States, again, thank you, and our best hopes and wishes that we all come through this together on the other side safely and well. What we want to share today is what we know at the moment about the forgiveness aspects of the Paycheck Protection Program. This is an incredibly fluid situation. As we're getting new comments and guidance almost daily, and in some respects we don't yet have some very crucial guidance that we're waiting on from the SBA. So with that, next, I want to focus your attention on our legal disclaimer. These are usually quite drab and routine, but I assure you in this situation, because of the ever-changing nature of this, it is all the more true that the information that's included and discussed in this presentation today is general in nature and should not be relied upon in providing tax or legal advice without independent research and analysis. Tax and legislative policies are ever changing or ever evolving. It's happened again in the last couple hours, I can assure you. Current updates to information and analysis included and discussed in this presentation should be considered. This material has been prepared for informational purposes only, and it is not intended and should not be relied upon for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. So with that behind us, hopefully many of you on the call today have already received your Paycheck Protection Program PPP loan funding. Others, we hope and trust, are in the queue and hopefully going to get funded here in the very near future. So with that, it moves us to the next phase, which is one of the most unique features of the Small Business Administration loan. This is referred to sometimes as a 7A loan, and that is the forgiveness feature. As of today, we are still waiting on the bulk of the guidance from the SBA that was required to be produced within 30 days of enactment of the CARES Act itself, which was last March 27th. So we should have seen the detailed guidance on the forgiveness provisions of the Act by this past Sunday. But as of this moment, we still have not. In the meantime, we have seen a flurry of activity around issues of some large publicly traded and very high profile borrowers who have sought and received funding that have now reconsidered and chosen to return their funding. And to that end, we've seen, as recently as a couple hours ago, Secretary Mnuchin of the Treasury comment that there will be an audit process for those who receive loans greater than $2 million prior to the granting of any forgiveness. So while we wait for detailed guidance, we have some basic direction that we can offer on the forgiveness process and the calculations. And you'll see at the end of our presentation that Kevin and I are going to share with you, we have a lot of unanswered questions that we really need that guidance in order to answer. So for purposes of this discussion, we're going to assume that all of the amounts that you receive will have been spent during the 8 weeks after your initial disbursement from your lender on what are referred to as covered costs. Those are basically covered payrolls, utilities, rents, and certain interest expense. And now the only question is how much of that can be forgiven. So that's our proposition for today. Next. The general rules surrounding forgiveness are that if eligible costs are incurred and paid, and that's an issue that we need more guidance on, during the 8 weeks following receipt of initial funding, then upon presentation of documentation and a request for forgiveness to the lender from which the loan originated, the entire amount of the principal of the loan can be forgiven, and any accrued interest along the way is paid by the SBA. The borrower will not be responsible if they use all the loan proceeds on eligible forgivable costs, and if they meet the requirements of basically retaining employee staff count and compensation levels at certain mathematical levels that we'll describe later. While there's the potential for full forgiveness, it's important to understand that these calculation mechanics and some of the timeframes involved can cause a reduction in potential forgiveness. And the SBA has already stated, interestingly, outside the bounds of the CARES Act itself, we believe, they've stated their intent to focus emphasis on payroll costs of being at least 75% of the total spend. With that, Kevin, do you want to take us through the detailed forgiveness cutback rules?
Yes, thank you, Terry. So as Terry mentioned, once you receive the funds, there's certain allowable uses to follow. And during this time, you need to accurately track the usage of your funds. There's 3 measurement guidelines that I want to go through that can help maximize forgiveness. The first of these is a 75% rule, or a 75% or 75-25 allocation. And this simply means that no more than 25% of the loan forgiveness can be attributed to non-payroll type costs, the rent, utilities, and interest costs. In coming up with this 25-75 split, it wasn't in the original statute, but if you think about the original formula, which was average monthly payroll times 2.5, 8 weeks for a covered period is close to 2 months. So that 0.5 multiple is another way to look at that, is really 0.25 for each month times 2. That's my best interpretation of how they've able to put the 25%, 75% guideline in the subsequent guidance that's come out. Next slide. Before we get into the next 2 measurement guidelines, I'd like to reiterate the intent of this program is to continue to maintain staffing and wage levels. And with that, if you don't maintain staffing and wage levels, there's 2 potential cutbacks, that can affect the amount of forgiveness. One of these is an FTE cutback, and another is the reduction of salaries and wages paid. To work through an example, let's take a closer look at the FTE cutback. This is based on a formula where you measure your FTEs for the 8-week period, starting with the date of funding, and you divide your average number of FTEs during that period over your choice of 2 different periods. You get to choose the one which is most beneficial to you. First period is this time last year, February 15th of 19 through June 30th of 19, or the first 2 months of 2020. And then there are some different measurement periods if you happen to be a seasonal employer. Next slide. So working through that example, let's assume you get a $1 million PPP loan and you spend it all on eligible payroll costs. However, during this 8-week period, your FTE number is 90. And then you compare that to the 2 optional look-back periods. Last year at this time, you had 110, but the first 2 months of 2020, you had 100. So using the most favorable, which would be the 100 from the first 2 months of this year, you would take 90 divided by 100, so 90% of the loan is potentially allowable for forgiveness. In this example, it'd be 900,000. From there, we move on to the next test. This one is a wage reduction cutback. This one is basically meant that you can't drastically cut the wages of those employees that are earning less than 100,000. And you measure this by tracking the payments during the 8-week period. And if they're dropping by more than 25%, that dollar amount in excess of 20% reduces the amount of forgiveness. And I'd just like to point out, there's an example on the slide that you look back to 2019, and as the statute is written, if any employee for any pay period had an annualized rate that exceeded 100,000 due to commissions or bonuses or something during one pay period, how it's written, that person would be taken out of that comparable base going back to 2019. Next slide. The statute does have some rehire exemptions, which basically negate the FTE calc and the wage reduction calculation. The first one is basically says any reduction in headcount. You know, if you cut the number of employees and you restore those by June 30th, then you don't have to apply that FTE math that I just went through. And then the second one is if you restore wage levels by June 30th, again, the wage reduction cutback doesn't have to apply. And under these rules, there's no requirement to hire back the same employees. So through natural attrition, as long as you're, hiring employees to keep your FTE headcount rules at a certain level, it doesn't have to be the same employees. However, under the wage restoration rules, this goes to an employee by employee basis. So with this, we'll turn it over to Terry, who's going to go through how to request loan forgiveness.
Great, thanks, Kevin. We don't have detailed guidance at this point on the process, but we believe that after the 8-week, what I refer to as the spend down period, has passed from date of first receipt of loan funding, after that 8-week period of time has passed, the borrower then initiates a submission request to the lender, providing documentation that's specified in the Act to document how the funds were spent on both allowable and forgivable purposes. We believe that that forgiveness request could be submitted as soon as the funds have been expended after the 8-week period of time. But again, we expect we'll see more guidance on that. Upon receipt of the request, the lender does have up to 60 days to issue a notice of decision on the forgiveness. Some of the documentation that's required to be provided is verification of the number of full-time equivalent employees and their pay rates, payroll tax filings such as one's Form 941 and a Wisconsin UC 101 state unemployment tax report would be examples of payroll tax filing documentation, as well as documentation of payments on other eligible forgivable expenditures, such as interest expense on pre-existing debt that was in place prior to February 15th of 2020. Likewise, rent payments on leases that were in place as of that date, and utility bills for any utility contract that was in place prior to February 15th. As I said, then the borrower will need to certify that these documents are all true, accurate, and complete, and that you use the funds to retain employees and make these eligible forgivable expenses. Next. In addition, for those who may have submitted for and received a $10,000 advance under the Economic Injury Disaster Loan Program. That's a direct from SBA loan program. To the extent that you have received the $10,000 initial grant on that type of application, that will be deducted from the loan forgiveness amount that you're otherwise eligible for on your PPP loan. And as I said, the lender has up to 60 days to render a decision. For those who may have received substantial PPP loans, in excess of $2 million was the number described today by Secretary Mnuchin. We can expect that there will be some sort of audit process initiated by the SBA prior to the grant of forgiveness. We don't know yet, of course, what that might look like or when it might occur or how long it might take. But just for those with significant borrowings like that, we do believe there will now be some sort of mandatory audit process. Finally, just a side point I would make, we did get some very friendly guidance from the IRS a week ago Saturday, and that is that the CARES Act provided for the ability for employers to defer paying in their employer share of Social Security payroll taxes. However, the language of the act said that if you're in the PPP loan program, you're not eligible to take advantage of this deferral, which can be a fairly powerful thing. It allows deferring out to payment in 2 installments. One is December 31 of 2021, the other December 31 of 2022. The IRS announced that until you receive your notice of forgiveness from your lender, you're eligible to defer payroll taxes under this provision. And then upon receipt of that notice, that will close this window. So you are able to get some cash flow advantage out of this friendly deferral provision, conceivably for as long as could be into the month of August, for example, depending on if the lender takes the entire 60 days that they're allowed to process your forgiveness request. Next. So that's what we know. Now let's talk about what we don't know, the unanswered questions that we're waiting on detailed guidance from the SBA on. And this is a litany of questions on all sorts of different topics, and there are many nuances that apply to any particular applicant. But our basic questions are, during this 8-week period after receipt of loan proceeds, what costs are covered? How do we measure that? Is it basically on the cash basis or the accrual basis or both? The language of the Act specifies that the costs incurred and payments made during the covered period are eligible for forgiveness. So does that mean that from receipt of the loan proceeds, only from that time forward as I incur payroll costs, and then if I in turn pay them by the end of the 8 weeks, is that the definition for potential forgiveness? Or am I able to seek forgiveness on payroll costs that were incurred up to the day before I received my loan, but that I paid the day after? We just don't know yet. And we think this is a crucial question for many that we're grappling with right now. Another question is, how are we going to measure full-time equivalent employees? Now, the SBA did just thankfully give us a little bit of guidance on this over the weekend, in that we believe they're going to adhere to the traditional definition of a full-time equivalent employee, which is 30 hours of service per week under existing SBA regulations. But again, until we see that guidance, we won't know for sure. Seasonal employers, as Kevin described, there's fairly small windows of seasonality that are described in the Act. Now, the SBA did just open that window up a bit to provide for a seasonal exception calculation for summer seasonal employers, but interestingly, they didn't give any grace to those that might have a holiday seasonal aspect to their business. So will we see that? We don't know. Finally, for the tax wonks on the call like ourselves, the question early on was posed: well, if I am explicitly forgiven this loan, And the act states that that loan forgiveness is not a taxable event, unlike most situations where if we borrow funds and it's forgiven, the Internal Revenue Code considers it taxable income, and unless we meet one of the exceptions to that finding. The act has said, no, this will be non-taxable loan forgiveness. But that begs the question, what about the expense side? If I use the funds to pay otherwise deductible payroll costs and rent and utilities and the like, do I get to still take the deduction even though I have effectively tax exempt income that I use to fund the deductions? And the answer is, we don't know yet. There is precedent in the Internal Revenue Code for the IRS to take the position that if you fund deductions with tax exempt income, that those deductions are now made non-deductible. We don't think it was Congress's intent here to provide for a bit of a double dip in the ability to take a deduction using tax exempt income, but we just don't know definitively yet. With that, Kevin, do you want to take us through the questions on some of the forgiveness issues?
Sure. Thank you, Terry. More questions. We're wondering if there'll be future guidance on how to apply that $100,000 wage limitation that we keep seeing in various parts of the Act. Additionally, as I work through that example, when you look back to 2019 annualized wages, does that bonus or does that commission in one pay period kick a person out of the calculation for the entire year? Additionally, I mentioned the 3 measurements that need to be made and monitored through this covered period. Well, what we don't know is the order in which they'll get applied. Do you apply that 75-25 measurement before those other 2 cutback rules, or do you apply them after? Mathematically, there can be a significant difference as to what order those are applied. Additionally, the SBA, will they clarify the wage reduction test to be based on overall payroll costs versus an employee by employee basis? Next slide. This first one on this slide, it's more of a technicality. We feel it's just poor wording in the statute that needs to be clarified, and that's basically, are you trying to compare 8 weeks of post-funding to a prior quarter, which would be roughly 13 weeks? Mathematically, it just doesn't make sense. But again, because of the poor wording in the statute, we're looking for clarification on that one. Under the wage restoration amount, they put in the 3 words, eliminated the reduction. Well, what does that mean? Does that mean, full dollar value of pay is restored? Does it mean an annual salary level? Just the salary level is restored? And then how does that, 75% of wage apply? You can reduce someone's wages by 25%, but when they say eliminated the reduction, what does that mean? Do you have to restore someone's wages up to 100% of what they were making prior to 215, or would 75% of the wage prior to 215 be adequate? We're not sure at this point. And as far as rehiring and eliminating the reduction in number of employees, you have till June 30th to do this, but could you have a strategy where you do this for one day to get, to get out of those cutbacks, but then could you effectively terminate someone July 1st? We just don't know. And then one thing that's not on this slide that I'd like to add is the, as time goes on here with this program, it's scheduled, the period is February 15th through June 30th. So what happens if someone doesn't get funding until, mid-May, late May? Is there going to be a strict cutoff at June 30th for, eligible expenses for forgiveness or use of funds? We just don't know how that cutoff of June 30th is going to work. And with that, I'll turn it back to Terry for some additional thoughts.
All right. Um, as we ponder all of the unknowns at this point, we know though that there are actions that we think everyone who has received a PPP loan or who is expecting to receive one should take, and that really revolves around documentation. Having a plan and documents in hand about how the loan proceeds will be used, having a budget that helps you hopefully optimize or maximize the amount of loan forgiveness that you intend to apply for, as well as having then all of the documentation available to present to your lender with the forgiveness is really job one. Planning, planning, planning. With that, we would recommend that you talk to an advisor, someone who can help you properly account for and document those loan proceeds in order to comply with the program requirements. And finally, understand that upon receipt of a PPP loan, this can have impacts on other stimulus provisions and aspects, both in the CARES Act and the FFCRA Acts, which Lonnie will touch on in the next part of our presentation. So understanding where you're not able to double dip or take advantage of between the programs is critical. And most importantly, as we've said, because of the host of unknowns and the guidance that we're waiting on from the SBA, stay tuned for additional guidance. I have no doubt that this will continue to change, if not daily, then certainly over a fairly short period of time. So I think with that, we'd like to field questions on PPP loan forgiveness. I think we have a few that have come in, Lonnie.
Yep, there's a couple that have come in so far. The first one really revolves around the use of FTEs versus actual headcount as far as the forgiveness goes. Do you want to just comment about that a little bit?
Kevin?
Sorry, I was on mute there. I think with the FTE versus actual headcount, the eligibility for the program was based on actual headcount, where a part-time employee would count the same as a full-time employee to meet the less than 500 employee eligibility. FTE, that's written in the statute under loan forgiveness, and that's the only place it shows up in this PPP program under loan forgiveness. And I have not seen anything which would indicate that they would shy away from using an FTE calculator for loan forgiveness. Terry, anything to add on that?
Yeah, exactly. In fact, that was the gist of the SBA's follow-up FAQ guidance this past weekend, was that they were going to fall back on their traditional definition of an FTE, which is 30 hours per week. Now, we don't know how they might aggregate to the extent you have, for example, two 20-hour employees. Is that constitute 1.5 FTEs? Or 1 1/3, or is it just one? How that's going to round out, we don't know yet. But we believe that the measuring point is going to be 30 hours per week.
All right, next question kind of revolves around use of retirement plan funds to utilize some of the payroll portion, whether that's a profit sharing 401k match. If it's paid in that 8-week window, do you think it would qualify yet at this point or not?
Good question. This will be one that will be caught up in the net of cash versus accrual definition, I believe, in the guidance from the SBA. If, for example, the obligation to make either an employer match or a safe harbor contribution, if that obligation vests during the 8-week period of time and then is paid during the 8 weeks, I think clearly it would be an eligible forgivable expense. What we don't know is if we're able to accrue that obligation. Let's say we have a calendar year taxpayer, an employer, and can we accrue and fund at the end of the 8 weeks based upon the actual payroll incurred during that time or not? Fairness would seem to indicate that we should, because again, Congress's intent was maintaining compensation, and 401k match and safe harbor matches are just another form of compensation. But unfortunately, until we see that cash versus accrual guidance, it's not possible to give a specific answer.
Perfect. Next one kind of revolves around the use of hazard pay for employees and whether that hazard pay would be allowable as well.
Oh,
Go ahead, Kevin.
yeah, I'll start with this one. I think, as long as it's reasonable, I think as long as it's, perhaps common in the industry, to have workers, to pay them a little extra during this time. If you can document other companies that are doing the same thing, you know, I I think this would be an allowable use of funds, and I say think because we just don't have any examples, and this is completely new to go on. Terry?
Yeah, I would agree. And I think here, prudence in how you do things between different employees is probably important. It would not be a good look, for example, if hazard pay were paid to one's family members that are on the payroll, but not to others that are doing the same duties. So, all the typical cautions that we would offer in a income taxation context, I think would apply here as well. But yeah, we've not seen anything that prohibits any kind of spot bonuses or hazard pay or shift differentials for serving out in the front lines. Nothing at all at this point.
Okay, and last question kind of revolves around related party rents. So you own your property in a different entity and you're paying rent to it. The thought whether is that related party rent would be forgivable or not, and then correspondingly, probably in regards to interest as well, would interest on that loan potentially be deductible? And I think maybe expand on that a little bit further as to what type of interest you feel is deductible as for the forgiveness.
Sure. Great question, and one that we've pondered long with clients. On the rent payments, there is nothing in the statute that prohibits payment of related party lease obligations. The focus for forgiveness purposes is that the obligation or the lease must have been in place as of February 15th of 2020 in order to be eligible. No reference at all to who the landlord is or how they might be related. Our caution here to clients has been abide by the terms of the lease. If the lease calls for payments on the first of the month, and that's been your mode of operations for years, continue to respect that and pay on the first of the month during your 8-week period of time. There have been some who've said, well, gee, can I prepay 6 months worth of rent then when I reach the end of my 8 weeks? And we don't believe so. We think that could be perceived as an abuse if you're outside the terms of the lease. Likewise, on interest expense, there is the ability to be forgiven the payment of interest, and only interest, by the way, not principal, on debt obligations that were in place as of February 15th of 2020. But the definition is a little goofy, in my opinion, on this. The statute calls it a mortgage debt on real or personal property. When we think of mortgages, of course, we think of loans that are secured by real property. However, the statute does provide for personal property as well. So conceivably, something like a line of credit that's secured with a GBSA across all real, personal, and intangible assets might qualify if that line of credit were in place as of February 15th. I had an interesting question posed recently about, well, what about my stock redemption debt that I might have to my parents? Let's say I've bought them out and I'm in pay on that redemption obligation. Can I be forgiven the interest on that that's paid during the 8-week period? And the answer is we don't know. we don't know if the interpretation of the security, if the security agreement behind that redemption agreement is perhaps a pledge of the shares themselves, or just a personal guarantee of the the family member still in the business, we don't know if that will qualify. So, here again, we're hoping for more guidance. Kevin, any
Um,
add-ons to that?
Well, I would just add that, even if it's a related party lease, there better be, or should be a signed lease agreement in the files going, prior to 2/15. These things are subject to audit, so, making sure it's a, arm's length rental amount certainly wouldn't hurt. I think that question maybe is if they pierce the corporate veil with, that might be, it might be inferring that to mean, well, would they look at it as like eliminating the related party transactions and then just, combine the operating entity with the real estate entity and then try to just, look at deducting the interest. I've seen nothing to indicate that, you would consolidate related parties in coming up with this calculation. And then lastly, as we get into some of these other costs, we have that 25% limitation. So depending on the size of the payroll in the company, I think a lot of times these, when you start adding up these other costs, you're going to be limited by that 25%.
All right, with that, I guess we'll keep moving on. We've got about 20 minutes left. So I just want to take a little bit of time to kind of run through the other provisions of the CARES Act, both from an income and an employment standpoint. So the act was official as of March 27th, 2020. So that's really our start date for many of the provisions in here. Next. The biggest piece, I guess, up front would be the delay of the deadlines. So number one, individual returns now July 15th for those. The other big portion of that is payments as well. So any payments that were due April 15th would be for taxes due estimates, as well, first and second quarter estimates. In addition to that, there were payments if you are a fiscal year entity that were due May 15th, those have also been pushed back. In general, I think this applies to individuals, corporations, and trusts, all of the above. Couple other components of that. Balance due payments are still due July 15th. And if you get to July 15th and you realize you don't have everything ready, you can still file for an extension. And at that point in time, the extension due dates would get pushed out to your normal due dates, September 15th and October 15th, as they would have been in any previous year. As Terry mentioned a little bit earlier as well, Social Security has also been deferred for the employer side. There are some caveats to that, which I'll get to a little bit later. Next. Take a few minutes to run through the individual provisions. So these are the sections of the CARES Act that apply to the individuals. So the first one, 2201, the recovery rebates, specifically are the rebate checks that are coming out right now to individuals. Next. There are phase outs for the rebate checks. So not everybody is really going to be getting a check in the mail. There's a adjusted gross income phase out that's going to be based off of 2019 returns. If 19 has not been filed, they're going to fall back to your 2018 returns. There are some bonuses to having children under the age of 17 that will be added to it. Non-filers as well will be able to apply. That filing period was online at the SBA or at the IRS.gov. There's still a link there that you can go to fill in your pertinent information as far as direct deposit. And then as far as the phase out goes, it's a reduction of $5 for every $100 that you go over on the limitations that are above. Next. Retirement plan distributions. So right now there's a full waiver of the 10% penalty if you're under the age limit for up to $100,000. Couple caveats with that is it has to be used for specific purposes. So you, your spouse or dependent has COVID-19, or specifically you were laid off in quarantine or had reduced hours, some sort of financial hardship that happened as a result of COVID. Distributions, if you do take them out, can be spread over 3 years, starting in 2020. And the little bonus on the back end, if you pay it back by the end of 2022, it basically is treated as a tax-free rollover and will not be taxable at all. Next. Also have the ability to do retirement plan loans as well. The previous thresholds were 50% of your balance or 50,000. In this next 180-day window, you can do up to 100% of your retirement plan or $100,000. There's also a waiver of required minimum distributions for this year. So if you have certainly a taxpayer that doesn't need the money and to make their bill payments, with the stock market being down, being able to defer that required minimum distribution certainly is a nice benefit for this year. Next. There also are a couple sections that were added for charitable contributions. Starting in 2020 and future years, there's going to be an above the line deduction allowable. So pre-adjusted gross income for up to $300 of cash contributions. There also was an increase in the limit as well, both on the individual side as well as the C Corp side. And then certainly if you're an entity that's donating food as well, there's a nice bump. The limitation had previously been based off of 15%. There's an extra 10% now of basically your deferred or lost gross profit that would be able to be deducted. Next. Student loan repayment benefit is also another thing that's out there right now. Basically, as an employer, you could pay your student loans for your employees. Right now, it's running calendar year through the end of 2020. There's a 5250 cap on this. But what this allows you to do, because there had previously been a provision where you could pay somebody currently going to school, but now you can also pay for a benefit for those that have already graduated as well. Next. There also are pretty expansive business provisions in the CARES Act as well. So the first one's the employee retention credit. What this is, it's a 50% of your qualified wages earned between March 13th and the end of December. It's capped on 10,000 of wages with a maximum credit of $5,000 per employee. In general, if you have 100 or fewer employees, there generally are no additional requirements. If you are over 100, there are additional things that do need to come into play as well, specifically in regards to the impact of COVID on your employee base. Next. The big thing about this is there's no double dipping. So in most cases, we assume that most of the small business clients that we work with will have a PPP loan in place. And if that's the case, like Terry mentioned previously, there is only a small period where this would apply. If you do get forgiveness on your SBA loan, at that point in time, any of these retention credits cease. Also, in regards to work opportunity tax credits as well that are out there, you cannot double dip on that as well. Next. The delaying of the payroll tax payments, we had some questions in regards to what actually can you defer. The deferral is actually just the Social Security portion for the employer. So anything that you withheld from your employee or the employer portion of Medicare are required to still be paid in at the normal due dates. You can defer the employer's portion, the 6.2% of Social Security, and if you do, it's payable 50% at the end of 2021 and 50% at the end of 2022. Once again, this is a small window for that as well. So once your PPP is forgiven, you have to stop any of those deferral payments. Next. There was a nice modification for net operating losses as well. With the CARES Act, it opened up net operating losses from 2018 to 2020 to be carried back 5 years. It also removed, there was an 80% limitation that had applied as well, and that was been removed for 18 to 20. So it creates some amended return opportunities as well if you had an operating loss that was potentially limited. Next. Loss limitations would be as if you incurred a substantial loss that was running through your return. Previously, with this past year, there was a limit where you could, if you're single or married, it was 25,000 or 250,000 or $500,000, and if the loss exceeded that, it was carried forward. Under the Act for 18 through 2020, those maximum amounts have been removed, so it potentially creates some additional opportunity to get some suspended funds that you had out there back into your hands. Next. The credit for minimum tax liability really only applies to corporations. If they had AMT at the corporate level and they were taking it over a period of years, this provision specifically allows those corporations to get 100% of those funds back into 2018. Next. There's also a potential limitation on business interest expense. You'll see this a lot on the real estate side more than anything else. The limitation was 30% of your adjusted taxable income. That limitation has bumped for 19 and 20 from 30% to 50%. It impacts partnerships, I would say, a little bit differently than it does S corporations. If it's a partnership, it really is only going to be effective for 2020. If you're an S corp, you have some opportunity to potentially get some of those funds back in 2019. Next. There also was finally a technical amendment for qualified improvement property. QIP really is just an improvement to an interior portion of a building. When the Tax Cuts and Jobs Act was created, it was a technical glitch basically saying that instead of being treated as 15-year property, it was automatically given a life of 39 years for non-residential real estate. Well, this changes it retroactively back to 2018, where it would be a 15-year depreciable life and then eligible for 100% bonus depreciation. This opens up the door to potentially amend some prior year returns, where if you did have something that was captured at 39 years, you can go back and amend. Or there's also the ability to do a 3115, which is a request for an automatic change of accounting, to recapture that depreciation from 18 and 19 and catch that all up on either your 19 return or your 20 return. Next. This one probably has just a small amount, but certainly if you are using alcohol to produce hand sanitizer, there was a federal excise tax in play. That excise tax for 2020 has been waived. Next. Just a few other things out there as well. So there's a qualified disaster relief payments. What these are tax-free payments to employees. It's not necessarily a payroll check. It's generally just a regular check to an employee. And it only comes into play in during a national emergency, which we were declared as such in March. So these payments can be for things such as setting up and maintaining a home office, additional childcare costs, or any other reasonable or necessary costs that you're going to help your employees pay for. As Terry mentioned a little bit as well, the economic disaster loan grants are also in play. They were just refunded. However, there's been a little bit of an issue with the SBA website where we don't know if anybody else will be able to further apply because there was such a heavy backlog on these in the past. What these are, you can get a grant up to $10,000, or based off of your employee head count. If it was less than 10, it would just be prorated as $1,000 per head. Next. Just a couple other additional resources that are in play as well. Certainly, any questions, we have a very large section of our website available, wipfli.com, dedicated to COVID-19. Certainly, there's some very good guidance on the IRS website as well, and providing a link to the CARES Act if anybody wants to see that as well. And flip to the next slide. These are the contact information for myself, Kevin, and Terry, and then I'll take any questions on the CARES Act, or if anybody else has any follow-up questions in regards to the PPP or forgiveness. We have about 5-10 minutes left. We'd be happy to take those.
We did have one question come in for PPP that it was sent to me privately, so I'll read it and then we can answer it. Is there a fine/punishment if you are aggressive in assigning payroll expenditures and then it is determined that some do not qualify? So I'll take a first shot at that. And first off, I'd recommend reading the certifications on the borrower application form that were initialed by the applicant. And then there is one of the certification does list, fines and prison time for any knowingly false statement to obtain a loan. So there's, that guidance out there. As far as, if you followed a formula that you thought was correct and then subsequent guidance came out after you submitted your loan application, I believe somewhere in the guidance that's been trickling in, I think that part of it is okay if it's just a matter of how you computed it, and you didn't, knowingly overstate payroll. And then lastly, I would add that, you always have the option to pay back any excess funds, work with your banker, talk to your banker, and say, based on our calculations, I don't think we needed this amount, and work with them to pay back any excess that you feel you wouldn't need. Terry, Lonnie, anything to add on that?
Oh, I agree, Kevin. And in fact, the SBA's guidance over the weekend that was aimed toward those who are rethinking their overall application is that you can make a repayment by May 7th with sort of a no harm, no foul outcome to it. So conceivably, if a borrower had a miscalculation and you know that now, and you're able to recalculate what your loan should have been, I don't see any reason why you couldn't work with the lender to make that repayment here by the 7th and fall within the graces of the SBA's forgiveness, if you will.
Any other questions out there?
Doesn't look like we have any more questions.
Right.
Thank you, Lonnie, Kevin, and Terry. We truly appreciate you bringing us this information. Thank you so much for attending. We will have a update with the SBA program, a representative with the SBA program tomorrow at 3:30. You can register online at greatergbc.org. And just thank you for attending. Thank you to Wipfli for being on this call and giving us all this great information. This is being recorded, so it will be out on our website under the COVID-19 resources page. Thank you. Oh, we had one question come in. Repayment by May 7th, if we overborrowed?
Yes, I think that's probably in response to my last comments. Right, the SBA this last weekend announced that if a borrower realized that they were not eligible after having received funding, they could repay that funding by May 7th and not be considered to have violated their certifications when they made the application. Basically a sort of a get out of jail free card, if you will. So extending that thought a bit, it would seem that if you over borrowed, excuse me, that there ought to likewise be the ability to repay any excess based on a new refined calculation of the borrowing base. But I would suggest working with one's lender on that to confirm that.
Thank you. All right, if we don't have any further questions, thank you all for attending, and we will see you soon.
Thank you, everyone.